Hi to all. So in this video, we will look at the profit diagram for both a call option and a put option. Okay. So now let's assume we have a strike, which is 45, and we will evaluate both a call option and a put option. Now we know that the intrinsic value, I'll write it again, of a call option and a put option, we know the formulas: max of stock minus strike for 0, max, whereas the put option intrinsic value formula is max of strike minus stock for 0. And there we go. So now let's assume we are evaluating all possibilities. So we have Coca-Cola or Walmart or any stock price, and we are evaluating what happens with the value and the profit of our options in all possible scenarios, all possible prices for the stock. So let's begin with 0, then 5, then 10, then 15, and so on. Let's scroll this down and let's be a little bit ambitious. Let's say, okay, we're hoping this is going to go all the way to $165, and it can go as low as 0. So now, what is the value of a call option? If we have a call option, the value of a call option here will be max of, now we can use the formula, right? Stock price, and now we're, in this case, we will assume stock price goes down to 0 minus the strike price, and let's lock this, or let's fix this cell. So we press F4, or we can manually add those dollar symbols before the B and before the 2. Max of stock price minus strike price, or 0. So the intrinsic value of a call option will look like this. Now we can, let's just go over the numbers first. The intrinsic value will be 0, even when our stock price matches the strike price, right? It would be 45 minus 45, so it would be 0. As soon as the stock price is a little above, crosses the strike price, we start having value. We're not having profits yet, we're having value, okay? So we have, for instance, a $5 intrinsic value as soon as the stock is at the price of 50. Let's give this a name. Let's give this, stay with the Coca-Cola as the name. So as soon as Coca-Cola reaches a price of 50, or whenever Coca-Cola stock price is being traded at 50, the call option contract we own has an intrinsic value of 5. The higher the stock price, the higher the intrinsic value of our call option. Now, let's call this intrinsic value. Let's wrap this, and let's say this is call option. So we will repeat this for a put option too. Now, what about profit or losses? Now, the profits are the value minus how much we paid. So let's assume the premium, it's $1. So the profits are simply the value minus $1. So we lock this cell by pressing F4, or by adding these dollar symbols. And now we scroll this, we just scroll it down. We can double click here. We can manually drag it down, or we can double click and it will do it for us. So we are losing $1. Basically, we're losing the premium if it doesn't, if it's not in the money, or in other words, the stock price is below the strike price. Now, the moment the stock price starts going, crosses the strike price, well, we recover the premium, and then we start having profits, and the profits are theoretically unlimited. So if the stock price keeps going up, our profits are growing, and at this point, profits are growing dollar per dollar. Every dollar that the stock is increasing in intrinsic value, the option is increasing by $1 as well, and potentially even more. So now we can plot this, and that's an interesting thing we can do. and we can plot this like this. We just have this line, and that's how the diagram, the profit diagram of a call option contract looks like. And it looks like this. We are having a loss, and the maximum loss, so that's the maximum loss you can have when trading options, when trading a call option, is the premium. And but you have access to unlimited gains. Now let's repeat these calculations, but let's repeat them for a put option contract. So we are going to paste this here. Now this is a put option contract. Now we know that the intrinsic value, the formula of the intrinsic value, I'm going to make this column wider, so, and this graph smaller. So now we know that the formula of a put option, we have it here, it's a little different, is strike minus stock. So max of strike, and we lock this F4, or we add the dollar symbols, minus the stock price, or 0. And we just double click here. When you place the cursor in this bottom and of the cell, you will see this cross. It becomes bolder. Then you can just double click and it will just scroll down, or you can just drag it yourself. You're doing the same, right? And then profit and losses is just, I'm going to erase these numbers. Profit and losses are just the value minus the premium, and we lock this cell. We already know how to do that, and we scroll it down. We already know how to do that. Now, if we insert a line, this is how the profit diagram of a put option contract looks like. And with a put option, your biggest gain is the strike price. Your largest gain is your max gain is basically the strike price, and that setting where you capture or you reap the highest possible gains from a put option contract. It happens if you think about it, the company just goes to bankruptcy, stock price is 0, and theoretically you can capture the full strike price because you could theoretically buy at 0, quote unquote, and then you could sell at the strike price of 45, and that's your highest gain. Now your highest loss in a put option contract is also with a long position. If you're buying a put option contract, your highest loss is also the premium. Now, a call option contract, on the other hand, once again, I'll mention this again. Your highest gains are unlimited, and your highest maximum loss is the value of the premium as well. So now we have these profit diagrams. We are sort of understanding better. However, in the quizzes, most likely what we will be dealing with is calculating the intrinsic value or the profits. So just make sure to memorize, to learn, or to write down in a formula sheet these two formulas, which are the ones you would actually be working with. And you can look at the previous two videos, one for calculating the intrinsic value and profit or losses for a call option contract, and there's another video calculating the intrinsic value and profits or losses for a put option contract. I hope this was helpful. Thank you for your attention, and let's keep in touch. I wish you all the best.